All right, all right. Good day to all. Sam here with you. We're midday on a Wednesday, January 31st, last day of the month, and had some. We had a tally, a vote this morning, and the winners. We have three coins we're going to look at today. ICX to Bitcoin was the first one we're going to do, and so. As I like to do, I've got the 1 hour chart here of ICX to Bitcoin on Binance. We'll come over here and look at it. I like to check here just to get, because I like the way that they score and use this metric scoring system, so I can get just a quick snapshot of what's going on with this coin. We have so many. This is just a, when you got how many, 2,003, I don't even know how many coins we have now. It's so many that if you're considering something, how much time do you have, right? Can you do all the fundamental research to dig in to understand it, or, is there maybe a place where you can get a quick snapshot as to how strong the project looks? So that's why I like to use this. So if I come over here to CoinGecko and I look at this, so on their metric scale, I always look for coins at 50 or higher. Well, 62% here already. Yet this coin's only been around for four months. That's pretty remarkable. Good developer interest. Those are the two things I want to see. Is it active amongst the development community? And where are we on the score here? What's the market cap look like? Well, we're at 2.8 billion in 4 months. Pretty strong project. So, if you want to dig deeper, this is a place where you can start that exploration. If you want to look at just the trading data, we can go over here and see where it's trading. So Binance is the primary exchange. We see 67% of it, which is why we're looking. We're looking over on Binance. So here's the 1 hour chart, and of course you can see this relatively limited history that we have here. Now what I thought we would do here is just kind of work through this in real time, kind of the way I would approach this. So, after a while, when you've done this long enough, certain things are just going to start jumping out at you right away. So is the count here extremely obvious? Well, not really, but there's a few things that are pretty glaring right off the bat. So, first thing that I see is this, which kind of is a bit of a tell. So, when I see that, so what does that tell me? Well, I know it's trading technically, right? So that's the first thing that I look at here, and I say, okay, now I want to dig a little bit deeper. So, I've already gone over to CoinGecko. I know this is a strong project. Well, now what else can I see here? Well, now I start thinking about that. Well, what would that imply? So if I look at that, so most likely where you're going to see that is, this would be technically this is just resistance offering support. But from an Elliott perspective, this likely wave 1, wave 4. Wave 4 coming to the tick, but again, not overlapping it that precisely. My first thought is, well, we've got Algos in here, because that kind of precision is not happening randomly. So now we look at that. Now here we get it gets a little choppy here, a little dicey with these extremes. So if I'm going to kind of reverse engineer this, and so so the first thought is, well, why? Why do we even care? Why do we care about what's going on here relative to what we see over here? Why does it matter? Well, I would propose to you that the reason that matters is because we're trying to get a handle on where we are in the count so that we know what to look for with regards to the fib pole. So it all comes back to looking for opportunities to buy into retracements, but we're trying to qualify the pivots so that we know which pivots to use and which statistical range we can use to our advantage with regards to an entry. Otherwise, none of this matters. Or you could say it this way. Well, if you're not going to qualify these or try and organize them in some way, how are you going to pick your pivots? Think about that. You could try and do something of a fractal nature and say, well, show me all the fractals. You can say, well, show me. You could put a zigzag indicator on this and say, well, show me pivots beyond X percentage. There's a couple of different ways you could approach it. You could just use your eye and say, well, swing low to swing high, or the absolute low to the absolute high. Well, now I've got a new absolute high. Again, it's the reason to apply the Elliott wave is it helps you organize and qualify certain pivots so that you can increase the probabilities of your entries relative to where you are in that count. Because otherwise, everything is just buying a 50. Right? Because we know that's what the algos do. So, and a lot of people trade successfully doing just that. As I've said many times, if you don't want to put in the time and the energy and the effort to become familiar with Elliott Wave and its nuance, it's not mandatory. You can be very successful just trading the fib poles with the market geometry. It's not mandatory, but as we work through this, I think I can build a case to show you its value, because ultimately it comes down to you never know. We don't know if the market's going to hold at a particular zone. All we can do is trade the probabilities. So I was having this conversation with someone earlier today about how you approach the market. So, I mean, one is, you could be looking for markets that are just going up and try and buy breakouts. I have found that can be a good way to approach the equity market, not so much in crypto, not so much in Forex or futures. So what I'm always looking for, this is, after 20 years of doing this, what I'm looking for is to buy retracements. Why? So why buy a retracement? Well, the way I think of it is if the market's going down, and I'm looking, so you could think of it, you could be simplistic and say, well, market's going down, maybe the market's on sale. You could think of it that way. Or you could say, well, if the market's going down and I'm looking to buy into that retracement, it becomes easier for me to quantify when I'm wrong. So if the market's coming down and I have if I'm trying to buy the 50%, I have a rule set that says, okay, I buy 50s and I stop out on the other side of the 65. That's certainly reasonable. That's how the algorithms are programmed. So that's certainly one reasonable scenario. Or you could look for more confluence. I want to find areas where I can get some market geometry. Maybe it's a median line, maybe it's a channel, maybe it's a pitchfork. Things that can help you build a case for a pivot. But if you're going to trade breakouts, it's an entirely different way to approach it. I always felt the problem with a breakout is the amount of risk that you have to take to know when you're wrong is just too much for me. I don't want to take that much risk. I'd rather try and get in as the market's coming down and be able to quickly establish a parameter, a defined range where I know that either that's more loss than I'm willing to take, more drawdown, let me say it that way, more drawdown than I'm willing to take. And if I can buy it as it's coming down and I can withstand that range of drawdown, then my upside is all the better. So that's just, I guess it comes down to how you want to approach the market, how you want to approach trading. As far as I'm concerned, it's just a smarter way to approach the market. Market's going down, I'm interested in buying. Market's going up, I'm looking at selling at targets. So let's enough of that. So let me try and build the case here and see if I can qualify what you're saying. So here's where it gets a little tricky. So if we work on the assumption that this is a tell, that's a tell. So I can work here and I can just right off the bat, I can look at that and go, okay, well that looks like there's a 1 wave, there's my 2, so this would likely be the 3. I get this retrace here. Is that my 4? And okay, so where am I? So potentially there's a 5 up here somewhere. So if I just start with that, and then maybe you could use the oscillators to help you here. So we look here and say, okay, well that's the peak, not by a lot, but that just barely higher than here. So that would imply that we've got a third here. So that's another way that you can try and, if you're not sure, is this the one? Is it 1, 2? Are we going to the 3? Is this the one? It's just a way that you can help kind of try and, again, play with the odds. What's most likely the third? Sometimes, these could be, relatively close in price range. So how are you going to help identify where the third and the fourth is? Well, this is the glaring one, but the oscillator is another way to, help yourself say, well, most likely that's the third. So then with that established here, I'm going to start looking for fib relationships. So I'm going to work from my swing low here to my swing high. Right? Well, I know that a 2 wave is likely to go between the 50. Well, it can go anywhere from the 50 to the 786, but the sweet spot is between the 50 and the 618. Right? But we know, again, so there's an example of that range. So if the market's coming down and I'm interested in being a buyer at the 50 because I know that's where algos are going to start buying it, I have a range all the way down to the 786. Well, do I want to withstand that much drawdown trying to buy into a 2? Well, that's, as I was just suggesting earlier, that's as much range as I want to give it. If I'm stopped out here, understanding, right, that very easily could see a situation where I get stopped out, it goes a little bit lower, and then it turns around. So, I've taken the maximum loss that I was allowing for, and then I end up, the market ends up going in the direction that you thought it was going to go eventually. That's trading. Right? What are you going to do about it? Right? So, what's your other choice? To put it down here, well, that's more risk than I want to take. Well, what's your other choice? Okay, well, so you could say, well, if I think it's going to be a 2, you could say, well, I'm going to wait for a breakout of the 1. Right? So you could say, okay, when it breaks here, when it breaks the 1, then I'm a buyer. Right? Well, what happens immediately after the break of the 1? And I didn't plan that out. I just happened to notice that. So if you say I'm a breakout buyer, well, eventually, right, it gets there. And then you might say, okay, well, I'm going to buy, if I think that's my 3rd, and I'm going to buy the breakout of the 3rd. Okay, well, when does it break out? Right here. What happens next? Right, and down it goes. So again, it could be that that's going to keep going, but are you willing to? Because one of these times it's just going to keep going. Right? How much risk? How much drawdown are you willing to withstand? Right? Are you just trying to get in and be a holder, or are you trying to swing trade it with some degree of money management? Right? Market's coming down. Well, so just looking at the chart. Right? Just not trying to be overly complicated, and I'm not trying to be condescending to breakout traders. I'm just, this is how I look at it. So if I could buy it somewhere down here. Right, now, granted, I got the benefit of hindsight. I understand that. But if I can buy it down here, and I know it's just come this far, it's just come that far. Okay, it was moving higher here. Is this just going on sale here? You can think of it that way. Oh, hey, we got a 30% off sale going today. Get it while you can, because it won't last long. It won't last long. Where do we go? Right back. It's no longer on sale. Oh, well, we decided to extend the sale for another day or two. Won't last long. Right? You see what I'm trying to show you? I mean, can I buy it here for that? Right? Do you want to buy it here, or do you want to buy it here, or here, or here? So if you're going to approach it from that perspective, which is what I'm encouraging you to do, then it becomes a matter of, well, how do I know? How do I know when it stopped going down? Well, you don't know. That's sorry to tell you. But you can do some things to help increase your probabilities, right? So we can use, I don't know, all of recorded time. As long as there have been charts, we can look at. We know that there are certain patterns that repeat. Right? So for some reason, the 50% seems to be, something that has become agreed upon. Well, if something was going higher and it comes all the way back to 50% of where it was, that seems to be something that we as human beings can look at and say, all right, well, that seems to be enough. Maybe it can go back higher again. So that's about enough. Maybe we can buy it here. You can be that simple about it as you like. But, so the point I'm trying to get to here is, well, if the market, if you don't know this is coming, right? So when it's over here and that's going down, how would you know to buy? When is enough enough? When does it stop? Well, so that's if you've seen this move, that's why we look for a 2 at the 50. All right, so it's come back half of it, off we go. Well, when's the next time we can get half of it? Well, again, you don't know when that's going to stop, because that could just keep going. Failures all the time, right? We post them in the room. Trade failure, because you have to see that you have to know. I want you to be a little bit uneasy buying it there, right? A little bit, so that you don't go, it looks close enough, we buy it. I want you to be a little. You should be. In fact, the better the trade, the more nervous you're likely to be, right? Because the market's going down, 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 down. Is that enough? Well, what can I do to build a case to help me confirm that that's likely enough? Well, we can just start looking at it, right? Because again, we don't know at that time. We don't know that that's enough. But we can look here. So let me take this off and go, okay, well, what can we see here? Well, this is the obvious one. But also, we've got this just a nice big shelf here. Look at all this as we come into this. right? We know, right? So we can look at 10 million charts, and we know that, well, prior resistance tends to be an area where I might expect some support. Right? Couldn't get through here. Couldn't get through here. You know, prior resistance, it's just, you'll see it, pull up any asset, right? You're going to see it all over the place. Prior resistance becomes support. Right? So, you know, you look here and say, okay, well, okay, good. All right, well, that's interesting, Sam. So what else can I learn there? Well, now if we start to look at it from an Elliott context, we can say, okay, well, we know that there tends to be a relationship between the length of the third wave relative to the fourth, and we have some statistical data to support that. So I can take what I think is my 2 low here, so there's the lowest low, up to my 3 high. Okay, where do we go? Well, we come a little shy, right? So this is for a fourth, that's deep for a fourth. Fourth tends to be more likely, you know, can be as shallow, and 38 to the 23, you know, you see in a very strong market. But in a deeper retracement here, we can go this low. So ideally, so you look what happened here, right? So you had this reaction here. So that's the first. You had it here too, right? So here's the first swing down. Reaction at the 50, up it goes. It can't get to the new high. Then it rolls over again. This is why this is the classic A, B, C pattern, right? So it's a push. They're trying to get to new highs here. Can't get it. Rolls over. Okay, so what happens next? So then you got to be aware that there's going to be an algo. There's going to be retracements on the other side, right? It's always a fib fight. So this, you know, we know if that's going to be a B wave. Well, you know, now I'm adding a little Elliott to it. But this push for this retracement here that's what creates a B wave. It can't get to new highs. Now, yes, there are times where we get extensions. We do get expansions in the B wave. Right? So again, there's no way to be absolute about this. These are tendencies in the market. So, but again, if we're just going to use the statistics, the odds are that we're going to top somewhere between the 50 if we're going to get an ABC, right? And again, we don't know that we are. But if we can go that high and we start to roll over, well, then the conditions start to present themselves for a potential ABC, 3-way, right? So what's the foundational premise of Elliott wave? Markets trend in waves of 5, and they correct those trends in waves of 3. So all I see right here, so if you didn't know anything more about Elliott wave than that, just the most rudimentary, well, I read it in a book somewhere, 5s and 3s. Well, you can certainly look at those pivots and go, well, potentially I've got a 3-wave correction. I had this big long move here, seems to be correcting it. So we look now, we say, okay, well, you went a little deep there, so where is the absolute maximum amount of risk that you would want to give that? Well, so here's the other side. So here's the 65 here, as I was suggesting earlier. I wouldn't want to give that anything beyond the 65. Now, this could overlap, and it wouldn't violate from an Elliott count. We could go down here and overlap the 1. We could, right? And then we'd have a diagonal, right? So this whole thing could end up being a diagonal of a 1 wave. That's possible. But the play is to build a case here. So we have this shelf here. We have the precision of the wave 1 high. Right, and that's to the tick precise. What we end up getting here is a front run of the 618, which is what algorithms will do. So you have to the tick. Well, here's the first tap of the 50. Reaction, can't get there. Here's the second tap of the 50. Reaction, rolls over again. Third tap, reaction. Ultimately comes all the way back down. Where does it stop? Right at the tick high of the wave 1, just in front of the 618. And this is what I've mentioned before. The algorithms, they'll start buying it here. Right? They will defend it all the way down to here. They will defend it here. Now, if this goes through, all right, so let's say, just for the sake of this example, so that you understand it, because this people get confused by this. If that were to go through, okay, what are the algorithms going to do? If it goes all the way down here, so just say we go to the 786 for this example. Okay, it's not that they short it here. It's not that they reverse their position, because that's not what they do. What they're going to do now is take this, well, there would be algorithms written for both pivots. But you'd have, the first one you'd look for is this one, because it broke. It broke that range. Do you see? So I'm going to take this off. So let's say this is our low here. I'm going to take this one off so as I don't confuse you with too many lines. So if I take that one off, okay, now we're coming back the other direction. Okay, so this is our pivot just for the sake of this discussion. Here's the next 50. Do you see that? So they're going to start selling there looking for this move down. That doesn't mean they're going to be right, but eventually they're going to get on the right side of it. Because they can withstand to be wrong. The pockets are deep enough. Wrong, 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 right. Right, very right. That's how they do it. Okay, so it's not a reverse to a sell. It's a reverse out. So essentially, if they get stopped out here on the other side here, then they're out of the market and they're just waiting for the next 50. Now, what happens if it keeps going? What happens if we end up with a diagonal? Okay, just to carry this forward. If it breaks the 6.5 here, they don't reverse and go long. What they do is, now let me take this off. Right, so again, just on the assumption that that's my pivot low. Here's what they do. Then they wait for the next 50. If that's the high here, then they wait for the next 50, and they buy that 50. Eventually, they get on the right side of it. That's what happens. Right? I'm not. This is not every algorithm that's in the market. I'm just telling you, there's a group of traders that have written algorithms to work this way, and you can see if you start testing this. I don't care if you go down to a 30-second chart or you go up to a monthly chart. You start looking for that. I mean, any equity class or any asset class that you'd like. If you start, once you know to look for it, you can't help but see it. And once you just start pulling fibs looking for that, well, then you're going to see it. Well, so what's the tell? Ultimately, the tell is what happens at their targets. Right, so here's the first one, the negative 23.6. And I can't explain to you why they decided that was the target that they were going to use. And oftentimes it will go through it. But very, very high percentage of the time, you're going to see a reaction at the negative 23.6 as the algorithms that were buying at that 50, that bought at that 50 here, are going to take profit there. And that's how at least sitting here in 2018, that's how the market moves. Right? So I've gotten kind of off track here of analyzing this coin, but it seemed like a good example here as we just kind of were freestyling through the analysis here. So let's get back to our analysis of the coin. Okay, so we're operating on the premise that we have a 1, 2, 3, 4, right? And we've looked at this relationship here in the 2 wave to the 3rd wave. Okay, so here's the front run on the 618. So we look here now; they're not to the target yet. They're not there yet. So if that's correct, so now I'm looking at this going, okay, well that was certainly a technical pivot, and I had this. So I had the ABC. So I had the A, the B, and the C. Okay, so that gives me more confidence that I've got a pattern, not just the fib pull. I've got a pattern here that I can look at and understand. I can go, okay, well I can also with 3 pivots, right? I love 3 pivots because what does that give me? That gives me pitchfork. Okay, so that's I've got modified shift on or a shift on there. So let me go to original, and we just you kind of back into it and go, not quite. Maybe the modified shift, not great. Shift, it's not perfect. So here's one of Andrew's median line trading principles. A failure to make the median line implies strength. So median line principle number 4. A failure to make the median line implies strength. If it can't get down here and tap the median line, then the rule is, or the principle, as Andrews called them, trading principles, is that a failure to make the median line sets up a move equal to or greater than 100% of the move that took it down. Right? So the length of this move equal to or greater than. So you could look at that way and say, well, I don't get the absolute median line pivot. I get the 50%, right? So I'm right in between here. I get the 50%. But so would that be enough? Would that be enough for you to buy it there? Well, it would for me, right? So I can look at that and say, yeah, would I buy it down here if we got to the median line? I would as well, but I would have been stopped out twice, maybe here. And then I would have been stopped on the 65. So again, so this is where you get used to getting stopped out. That is just part of your experience. That cannot be something that you're afraid of. It's got to be okay. Well, played the odds. The trade didn't fly. What's next? What likely happened there? Well, if I got stopped out here, what's likely happening now? Where's the next pattern price? Geometry that I can use to my advantage. What's the next thing? What else can I find here to build that case? Is there any relationship between the length of the A wave from the B wave? Can I do this? Do I have an A wave relationship? Well, that kind of gets interesting. So I get this. So very common target for the C wave is 100% the length of the A wave. Well, it's right here in between, if you can see that. It's right in between in the golden pocket, as I call it, between the 618 and the 65. So there it is. So again, building a case here. So it's in between. So you have this little golden zone here, but the algorithms are going to front run it. So you can't put your entry right on the 618. If you're looking to be a buyer at the 618, you've got to front run it just to get filled, because they'll leave you hanging there. They will. They do it all the time. Now here you could say here, that went right to the tick. Yeah, that's right. But if you want to get filled, if you want to get in that trade, you got to front run it a little bit, because that's what they will do. And you'll be sitting down here, you won't be filled by 2 ticks, and the thing will take off on you. So, but my point being here, now you're building a case for a trade here. So I've got the 100%, I've got the 618, I've got the wave 1 high. You see, so I mean, then I could look at this and say, well, maybe there's a channel on this that I could look at and say, maybe not quite. So the geometry got left hanging just a little bit on this, but there's enough there, given that pattern, that I would take that trade. I would take that trade. Now, I'm not in this. I'm not suggesting that I took that trade. I'm just analyzing this because members asked me to. But if I look at this, if I were looking at that, I would have started buying here. Right, and I would have taken some heat. I would have taken that heat right up to the other side of the 65. So this would have been a place for a potential add. As far as I'm concerned, that was a potential add. So as I'll often tell members, first bite at the 50. Just in case it doesn't make the 618, because we're looking. Remember, we're under the assumption that we've got a 1, 2, 3, 4. So high probability zone for the 4 is between the 38 and the 50, right here. So the fact that we get the reaction there, well, so 2 things could have happened there. One, if you're a buyer at the 50, you get the reaction, you tighten up your stop on the assumption that the pivot's in. And you come back down, you get stopped out either at break even and a small loser, and then see what happens. And then we come down here, we had this next probability zone. So the way you might have approached that is first buy here at the 50 because of the pattern, because you're playing off of a wave 4. Get a reaction, stop could have been tightened, or you're like, oh, okay, good. We get a little pop. That's not a lot of hours here, so maybe you had 4, 5, 6 hours where you're in a bit of a profit, and then the thing rolls over here. So if you moved your stop, you got stopped out here. Right, so that's one very valid way to approach that. If it comes down, if you're not out, well, then you had to in your mind understand and accept that you were willing to take that amount of drawdown. If you bought it here, you're going to front run it. So you front run the 50, and you're willing to take it all the way down to the other side of the 65. You see that? So either it's a first little, small entry here on the, because you don't want to miss it. So a small entry here because you're playing the odds of where the 4th wave is likely to be. Accepting that if you're going to take that drawdown, it's not going to hurt you too terribly much because you didn't go heavy here. You've got a chance to add here. What happens if you add? Well, now I'll just use the box as an example. You've averaged your price down. So if we split the difference, now you have an entry here. So you've averaged that price down because of the front run at the 618. Right? So if you get stopped out, you take the maximum loss on the buy at the 50. You take a much smaller loss right here. So look at the 2 boxes. So you're taking the maximum loss with the buy at the 50, that you were willing to accept that risk for the potential reward. You're taking a much smaller loss on the 618. Another advantage of buying at the 618, right? That's why I call it the golden pocket, because I like it because the risk reward can be so small, and you can trade that with so much precision. Right, so we get the ABC there. Now, so let's go back to analyzing where we are now. That's enough about that. I really did not intend for this to get so long-winded here. I'm at 30 minutes. Maybe we'll make this a training video. Okay, so we get this now. So what's next? Okay, if this is my 4 and I'm expecting a 5, well, let's take this off, because now what I would do here though, I would want to be sure to have marked or note or put my wave 5 here at where that algo target is, because how precisely this is reacted to the 50 then the 618, I want to wick off that negative 23, because I know that's an algo target. I know there's likely to be a reaction there. Doesn't mean that's the top. I'm just looking for a reaction there. Right? Do I have any divergence? Well, you can see up here RSI has gotten hot. hot, right? But that doesn't necessarily mean it's the top. It's just you might look for a reaction. So now what am I doing? Well, if I think that's a 4 and I'm looking for a 5, I'm expecting that to subdivide. So if I know I've got a good pivot here. Now, so the market moves away. I'm like, whoa, well, look how beautifully technical that pivot was. So now, back to where I started, I have a high degree of confidence in pulling fibs from that pivot. So if I take this off, right, so I'm in an impulsive wave here. So I'm looking for a 1-2. So just as I was looking for this 2 at the 50, now I'm going to pull from this low. Here's the highest high. What am I going to get here? Well, look what happens here. Right to the 618. Yet again, exactly what happened here. Exactly. So they front run here, up they go, reaction, come back down, they test it again. Boom, they defend. Right. So there's a good example of what I was talking about before. Right? They defend it. It gets challenged. So here's the entry. Look at the reaction here. So you get this reaction. So look what happens. They come down, test it, boom, boom, big reaction. Up, can't get through the resistance. Can't get through. It rolls over again. Well, the algos that bought it there are going to defend it right up to that point. So it gets bought again. If it gets on the other side, things change. They defend it. Look at the reaction. Right? So it gets defended. Where do we go? Now, take note of where it went, to the tick. Right? So, and then not only do we go to the tick to the algo target, right? Look what happens. What's the reaction? All the way back down. Right? Do you think the algos sold it there? Right? I don't know how else to build that case for you. I didn't pre-choose this coin. The members picked this coin. I just pulled up the chart. What I'm trying to tell you is, I don't care what you pull up. You pull up Forex, equities, futures, anything you pull up, you're going to see this over and over again. Because this is the way the algorithms are written to respond. Again, this was not cherry-picked. I could not have cherry-picked this. The members voted on this coin. I barely knew of this coin. But I sure liked what I saw over here. 4 months, we're already at 62, already at 2.8 billion. Wow. What are the odds? Just looking at that, you go, what are the odds that the algorithms are in that? Well, we come back over here and we say, is it technical? Are they there? I don't know what other evidence I can give you beyond that. So now, is that the top? Well, let's think about that. Is that the top? Well, it's the top of something. So we look here and we go, oh, okay, one. Looks like that's 2. So it looks to me like, so what is the only outcome here? Let me get rid of that I could end up with here. From an Elliott perspective, what do I have here? Because if this is my 1 and this is my weird 2, right? To take us down to test this again, I get the reaction. So there's only one from an Elliott perspective. There's only one count that can work here, right? 3. We've got to have a diagonal. Right, to get up there. So if we have a diagonal, what we're going to do, right, per Elliott rule set, we're going to pull from the low of the 1 to the high of the 3. Right, we're looking for the 50. What do we get? Right to the 50. Yeah, it ticks through a little bit. What else do we see here? Prior resistance offering support. Right, it gets through it, but it's right there. Get that to stick. Little shelf of resistance. What do I have here? I've got a little divergence here. The RSI, excuse me, I've got a double top here, between this peak and this peak. I wouldn't really call that divergence yet. So one of 2 things happen here. Either now we have an ending diagonal, which would complete here. So note where this target is. Right? Do you remember the first target I drew? Do you remember this one? So I've got this box I drew was off of this one. Okay, so here's this. So let's go all the way back to where we started. Let me get that hot. Okay, so I take this low. That was the first one, right? So take note of what we see here. Look how this starts to line up here. So this is the negative 100 of the length of the 1. Right, so knowing this, as I've mentioned in a number of videos here, we start to see some confluence. We know that negative 100 is often very close, if not right on top of the 1618 projected from the 2. So if I pull this all the way over, well, it's not right on top of it, but I start getting a range here. What else can I get? What else can I get? So I've got that as a contender. Here's the 100%, 1272. So the first, if I look from this first pull, from the length of the 1 projected from the, projected from the 4. Now look at this lineup. So there's the 100%. Right? So I'm getting a huge confluence zone up here. Big, fat confluence zone. What else do I have here? Well, I can pull from my 2 low. Come here. I can pull from my 2 low to my 3 high. Look at that. Okay, are we getting, now you really start to dial it in. Are we starting to get some confluence there? So now you look at that and go, okay, I'm sitting at the 50. I've got a massive, massive confluence zone up here. Is that a trade I want to take? All right, look what's already starting to happen. Now, that's not a get-rich trade. But that's a beautiful swing trade. Why would you not take that? Let me put it to you that way. Why would you not take that? Right? You worried that went too deep? Right? Well, we know that if this is going to be, let me change that color because I've got so much green here. If that's going to be a 5-wave sequence, I can end this 5th with a diagonal. Look at this massive cluster I've got up here. So as far as I'm concerned, that's just a no-brainer here, taking that, right? So stops on the other side of the 65, right? Or you could put the stop on the other side of the 2 because it invalidates. If we blow out the wave too low here, if this goes too much farther, so if I think about risk-reward, okay, so if I'm a buyer here at the 50, here's my target. If I want to give it maximum, I'm to tick on the other side of this wave too low. That's the maximum you would need to give it. What do I get there? Call it 3 to 1. Do I want to be a little tighter than that? You know, I can be just on the other side of the 65. Now I get 3.5 to 1. Right? It's not a get rich trade. I mean, you go pretty heavy there, because your risk is so low. But what are the odds? Right? Again, I mean, you trade these until they fail. So far, it's been absolutely technically perfect. And I've got this massive cluster here. Why would I not take that? And then the only other thing you could add to this, I know this is getting hard to see, but I might add that. We're to the side of it. So I would start playing with that and looking for other 3 pivots where that might come into play. If I can get that hot. So you might switch over and say, okay, maybe there's a channel. So I know a modified shift is going to be just like a channel. And so that would give me the upper parallel. That's the modified. There's the shift, upper parallel coming right in line with that. So again, doesn't mean that this is guaranteed to get there. But that's about as good a setup as you're going to get. If you've got a better one, send it to me. I'd like to see it. All right, guys, I went way longer than I thought I was going to go on this one, but I think a lot of good things to learn there, right? To see that. Okay, I will wrap it there for that one.